Action.
Hi, and welcome back to Tilt Talk Tuesdays.
Tuesday Tilt Talks. Come on, it's
an order of some
three
T's. I got the words right, it's just not in order. Maybe
seriously,
I'm dyslexic.
We giggle every single time we start Tilt Talk Tuesday Tilt Talks. Wednesdays, Thursday, Friday Tip Talks. No?
Come on,
No.
Tuesdays. Anyways,
Tuesday Tilt Talks. Here we are.
All right,
on Tuesday.
Imagine that.
And we're doing our Tuesday Tilt Talks.
We are here to talk about joint venturing.
Well, the thing with Krista and I is we go through all kinds of. What was that noise?
Oh, that's the.
Oh, it's the delay.
I have this in front of me in case someone decides to ask a question, which we'd love for people to ask questions.
Well, we got to get as a phone number for people to call in.
A phone number?
Yeah, how cool would that be?
I don't know if that's a part of Facebook Live.
So part of Tuesday Tilt Talks is we want to be super transparent on just our journey and our experiences in buying real estate. And It's funny how, every Tuesday it's like, hey, what are we going to talk about? And or the next Tuesday, what we're going to talk about. And it's always just leave it because something's going to show up.
Well, we always have lots of ideas, but they may not be right on the day.
And we're trying to get a certain flow of topics. So we have this, we have a bunch of stuff written down where, that topics that we can talk about and how they flow in. And we started up our real estate education group, and we have our Tilt property management group. We have our staff who are still buying. So there's all kinds of topics. But one topic that keeps on coming up for us, especially a lot lately, is joint venturing.
Yeah.
And since we have so much joint venture topics or experience or history and maybe
history.
I don't want to say drama, wrong word, but there's a lot of shit going on right now. Wrong word, shit. But there's a lot of stuff going on with our joint ventures and our portfolio, from buying them out to cash calls to just experiences that we're getting right now that we never ever once understood or thought we'd ever get. So we're going to talk about joint venturing. I
feel like I want to ask you a big question right at the front end, but
do it.
I think we should wait till at the end.
No, ask it now.
Just know that I'm coming at you with. Okay, I'm going to tell you it now, but then you're going to answer it at the end.
But I get time to think about it.
Yeah. My big question is going to be: had you known then what you know today, would you still be joint venture? Would you stay smaller and not joint venture, or would you grow by joint venturing? Don't answer.
I think I should answer that.
No.
It's a really good question.
Yeah, but we'll unpack it.
Ooh, unpack it.
And maybe we'll get some people engaged here. And as we talk through our if I want to mess them up, I'll use some big word.
And she never knows what the word is. Like, she has no idea what this word is.
I totally do.
She makes up random words all the time. And then I always go up to her and say, Chris, you have no idea what that word means.
No, I do, but he doesn't. So that's what he does.
Just for the record, I know what the word unpack means.
I know.
So
I know.
just so we're clear.
But it made me think of that.
So one thing that works really, really well for Krista and I, what we're finding is kind of an interview style. And Krista is really, really great at, pulling stuff out of people and, getting people talking. So in staying with that concept, I don't know, I'm assuming we're going to stay with that approach, kind of an interview style. But instead of you interviewing me, I think you have lots to give on this topic as well. Because back in the day, you used to do all of our joint venture reporting and supporting, if you will, for financials and stuff like that. So because that's a big problem. So I think it's probably best just to kind of riff ideas back and forth, right?
Okay, so let's start there.
Let's do it.
Let's start at the administration of a joint venture. So I'm just going to talk about that a little bit, in that to do a joint venture well, you should really be doing.
I really badly want to answer your question.
I know. Okay. Nope, but you can't. So to do a joint venture well, there should be a lot of reporting. As with any financial deal, the partner should be getting reported to, right?
Well, the mistake that we used to make back in the day is we started out strong with the reporting and doing, quarterly or monthly reporting or whatever we were doing back then. I think it was quarterly reporting.
Yeah.
But the problem was we were growing pretty fast, and the cash flow was so well. Like, we were cash flowing thousands of dollars a month in those portfolios, that everything was always just such good news, and we kind of got away from the reporting.
Yeah.
So, looking back now, I wish there's lots, man, there's lots and lots. How about this? What would be the top? I know we can go all over the place, and we're kind of, so anyone who's watching, I apologize if we bounce all over, but it's all on the topic of joint venturing.
Yeah.
What would be the top 3 mistakes you think we made with joint ventures? Or 2 or 4, 5,
There's
whatever.
So many, like not having everything in writing. And we'd have you would have lots of conversations. And then, when you have a conversation, someone says, yeah, okay, got it. But it's not in writing. So then when you however long later, when you go to revisit that conversation, remember when we agreed to this, or decided we'd pull this money out to do this, or
and when things are hot, when things are going really, really well, it's never a problem.
Yeah.
And it's when things aren't going well that people don't remember certain conversations.
Yes.
Because they get used to the agreements. They get used to either getting that money on a monthly basis or on a quarterly basis. And then when it's gone, it's like all of a sudden, everything's blown up.
Yeah.
And they forget the conversations just because they got used to that money, right?
Yeah. Or maybe we thought too things would go a certain way, and maybe we needed to do a cash call or whatnot before we expected it. So then, just like it's unexpected for us, it's unexpected for them. So of course, we can leave a conversation assuming it's going to go a certain way, but if it doesn't, that's nobody's fault. That's just it's an investment.
So mistake number 1, poor communication.
Yes.
In the sense of no written, maybe not enough written down communication, no follow-up on conversations.
And this is where in a partnership, there's some challenges in that Jared's gift has not been administration. And so
don't talk like that.
No, it's true. And
I'm terrible at it.
Yeah, but that's fine. But so, anyways, if I wasn't folded into a conversation and then we just didn't have things in place to do that, nor did we realize that we should do that. Were I to do it again, the other challenge is we were starting out still. We built pretty fast. And so when we started into joint ventures, we were still reasonably new in real estate. Well, very new in real estate. So
we had 13 properties on our own before we went into joint venture.
Right. And those 13 properties, it's not like we were seasoned investors with clear systems of, like a really strong administrative system. So, accounting, all these things, it's not like now, if we went to joint venture with somebody now, we have a team, which is super helpful, but, I would have really clear reporting, and that would be super easy. It would go out on time.
So what kind of reporting would you give?
I would probably give quarterly financial reports with,
because one of the comments that we get from one of our partners now is every time he hears from us, it's something bad.
Right.
It's give me more money, give me more money, give me more money. Now, that's the state of the economy. Like these properties are up in Grand Prairie, and we're cutting checks like crazy on these properties in Grand Prairie. Rents have actually come up, a fair bit in Grand Prairie, 20-30%. However, our expenses are just out of control.
Yeah.
From boilers, roofs, furnaces, water tanks, new flooring, kitchens, stuff like that, just because these houses are gotten to the point where we have to now start putting that money into it. The partner that we have doesn't really understand that.
Right.
So with all that said, what kind of reporting would we do differently? Yeah.
So I would move away from you'd probably have a telephone conversation with our joint ventures.
That's what we used to do.
Yeah.
Totally.
Quite often. But I would formalize that and do it in a letter or, a written report,
right?
Essentially,
like a summary, like a written summary of the last 3 months of the property. I would break it out into here's what I don't want to say is going wrong, but here's some challenges that we're seeing in the portfolio. And here's what I'm predicting or projecting for the next 3 months, maybe in the portfolio.
Right.
So then the next 3 months later, when you go to do that report, here's the summary of your prediction. How accurate were you? So now that turns into the summary. and then you do another 3-month prediction.
Yeah.
So that's one lesson that I learned. That it's funny you bring that up, because we haven't actually talked about this. Our do's and don'ts or redos is so we have the same one, is different reporting to the joint ventures to keep them in the loop, because at the end of the day, they're entrusting you, us, me, you, as their finance advisors, essentially, financial planners, where they've entrusted us with their money to go invest in real estate. Yeah. And it's up to us to manage their intentions and expectations and energy around their money. Yeah. And like I said earlier, everything works out great when money's aplenty. Right. And when there's no money, all of a sudden we have problems.
Well, and did you ever think that we were going to have to do cash calls in our company?
I never
into the joint ventures.
No. I never ever thought of a cash call.
No, me neither.
Back in the day, we were doing in 2000. Well, we didn't get our first joint venture partner until 2005, but from 2005 to 2008, house prices were going up at a ridiculous amount. Mm-hmm. We're talking 30, 40% year over year. Mm-hmm. We were cash flowing like tens of thousands of dollars, maybe more a month. And, I remember giving joint venture partners checks of 9, 10, 15 grand a quarter. Mm-hmm. That was our cash flow. It was just unreal. And I never once thought about it. However, in saying that, we were pretty smart with our share of the cash.
Personal,
because we weren't taking that money and buying cars and trips and trailers, and we did buy all that stuff, but we weren't really doing that. So
say that again.
We weren't taking that money and spending it on depreciating stuff. We were reinvesting it back into real estate.
Yeah, that's right. That's the confusing thing is. We have so many different umbrellas of what we do. Mm-hmm. Anyways,
but we weren't taking that money and spending it. So, we were redeploying it or reinvesting it, where what we're finding now is when the market started dropping, some of our joint venture partners were used to living off that. Yeah. And as the market starts dropping, all of a sudden their income starts going down, and their quality of life changes. And then all of a sudden, all these conversations, like I'm just trying to paint the picture of how a lack of communication or not properly tracking a conversation comes back and bites you in the ass. Yeah. So then the market starts dropping, and all of a sudden they don't remember conversations because they need this money. And all of a sudden you have a massive fire in front of you that you have to deal with.
Well, to the point where I think some don't even remember getting the money that they got. So, and that's all in our books, but it would be nice if we had, so as a bit of an anal paperwork person, had I to do it again, I would have a really almost like a general ledger of the happenings. So at a quick reference, I could look and see, okay, because everyone thinks they're going to remember something. Oh. What did I did? Oh, this brings me to a really funny story. The meeting with Larry.
So you want to share that story?
Yeah, this is so funny. So we are going through our calendar for the week and making our plans and putting some things in, and I had this random
5 days ago, Krista comes up to me, she's like, who's Larry? So in our calendar we have this guy Larry
meeting with Larry
scheduled at 10 o'clock or
10:30 on Tuesday.
Yeah.
And I said I must have pressed Siri or something and it made an appointment because I don't know a Larry. And so then we were joking, can't wait till 10:30 and see who Larry is. And anyways, I got a call about 10:36 or something. And it's our financial planner fellow. So we had a meeting with him just last week, wasn't it?
Yeah.
And this Larry was coming into town and he squeezed us in for this appointment.
Which we almost forgot about.
And his name was Larry. And so I put in the meeting. Anyways, so my point is, in that meeting, I never would have thought that by Tuesday I would completely forget having put that in the calendar. Totally. And that's less than a week.
Yeah, totally.
So do not trust your brain. And be, especially for the people who aren't administratively strong, because maybe your books aren't as clean as they should be, but I don't care if it's a piece of loose leaf with a date and the conversation with, and especially all of the finances in and out of that, because it seems right now, truthfully, it sounds a little silly, I think, because looking back, it seems so obvious.
But back in the day, nothing was obvious.
No, just because
we had no one telling us this shit.
Yeah.
No one was guiding us. No
No.
one, like back in the day, like I keep on telling, like in our workshops that we put on once a month, and our next one's March 13th in Edmonton. But in the workshops that we put on, I consistently tell people and teach people and try to educate people is buy your properties based off the lowest rents you've seen in the last 7 years. And these are lessons learned, because the market, when it was hot, we just assumed it would always stay hot.
Yeah.
And when cash flow is rolling in like crazy, who cares about conversations?
Yeah.
Because
So if
every mistake is hidden because you're making so much money.
if you had done that, would we have seen the dips coming like they did?
We wouldn't have seen the dips coming, because I don't think anyone saw those dips coming. But
Right.
if we would have been buying better cash flowing properties, we wouldn't have almost went bankrupt in 2010.
Yeah, it
And-
started there.
Absolutely. And if we would have been reporting it to our joint venture partners, it wouldn't have been such a shock to them.
Yeah. Yeah.
And we even have joint venture partners who are heavily involved in our portfolio, in the management of the portfolio. Like, hey, they were like literally right beside us along the way, one of our JVs. And it's I look back on that, and I really, like, right now I don't buy a property unless it cash flows $400 to $500 a month.
Yeah.
And if it's not cash flowing $400 to $500 a month, I'm not touching it. And so looking back and sitting with a joint venture partner, can you imagine sitting with a joint venture partner today? Let's role play. Hey, and I'm sitting down with you now in this role play. You probably won't get a talk, because I'll just do your conversation in mine. But so it's going to be, hey, Krista, listen, I'm thinking about investing in real estate. I want to get, hey, Krista, I invest in real estate, and I really want to buy this property. And this property, it's going to cash flow. Here's the purchase price. Here's where it's located. Here's what it's going to do. It's going to cash flow, $400 a month. And, listen, I get your money is super valuable, and that's actually the asset. The house isn't the asset. It's your cash. That's the asset. And I really want to protect it. So first of all, we're going to buy a property that is, completely renovated or new, and here's the cash flow and here's the tenant profile. But listen, that cash that we're going to take, instead of splitting it, or that cash flow that we're going to get, instead of splitting it every month, we're just going to keep it in the bank account.
Yeah.
We're never going to touch it. And I don't get paid until it sells. You don't get paid until it sells. But more importantly, we're going to protect your asset.
Yeah.
Can you imagine having that conversation now versus, hey, Krista, I'm looking to buy a house that's going to cash flow $100 a month. You're going to get 50. I'm going to get 50 every 3 months. I'm going to cut you that check.
Yeah.
Right.
Well,
big difference.
and I feel really responsible for that. And let me tell you, that's not a great feeling.
It was all your fault.
Yeah, no, but it's what I mean is, had we known different, we wouldn't have gone down the path that we went down. And so then, some of those hard feelings that maybe got created with joint ventures getting surprises of cash calls and things could have been avoided.
Because really from 2009 on, it's been challenging for some joint venture partners.
Oh yeah.
And
it's funny because really, let's be honest here. A joint venture is a marriage, and and just like you shouldn't get into a marriage if you don't know what you're getting into, and you should communicate. It's the same with a joint venture, and just like a divorce is messy, split joint ventures are not pretty.
So two things, and I totally agree with you. Split, ending a marriage sucks. Ending a joint venture partnership sucks. And we bought out 3 joint ventures partners over the years, and every single one, really except for one, my dad.
No, 4. Yeah.
Well, yeah, because your parents, my parents, and then we had the 2 other ones.
Yeah.
And so we had 4. We bought out 2 aside from the 2, or we had 4. We bought them all out. We have 1 left, and of those 4 that we bought out, 2 were family, so we still have good relationships there.
Yeah.
But we left a little money on the table when we bought them out.
Yeah.
It's not like.
Well, that's the difference between the family ones and the non-family ones. Every time we've left money on the table.
Yeah.
But we did it because, to get out as clean as possible.
Every joint venture partner we bought out, we've left money on the table.
Yeah, but they don't understand that.
Right.
Yeah.
We've overpaid for the portfolio, but in their world, they got screwed. Because along the way, the deal changed. Our agreement never changed, but the market changed.
Yeah.
And all of a sudden, cash flow goes away, and then they forget how much we've paid over the course of the term.
Yeah.
And because we didn't track it. So with that said, there's 2 things that I want to go back to. I originally asked you what would we do differently.
Yeah.
And one of the things you said was report differently on a monthly or quarterly basis. I don't
more complete.
Yeah. So have a complete a reporting system.
Yeah.
And 2, improve communications and follow up all communications. I would say follow up all communications with written conversations or dialogue to summarize a conversation that you had.
Especially if there's more than 2 people.
Right.
You know, rarely I would say is a joint venture just me and you.
Right.
It can be 4 people. There can be partners or couples. There can be.
Well, that's the other mistake is now, you know, me and John do business. John has a wife. I have you.
Yeah.
So now there's a whole new dynamic that isn't, you know,
getting communicated
to, and that creates a whole other kind of problems.
But if it's on paper, then there's nothing to
What else would you add? So if we're going back to 2005, our very first joint venture partner, you know, how would we do it differently? I would also have quarterly meetings with all partners.
Yeah.
You know, so that's me, you, John, and his wife.
Well, now, and let's be honest, that is not hard, even if you're in different cities. There's
not nowadays
with technology. Let's just get on a FaceTime call or
or
Zoom
Skype or Zoom or something.
Yeah,
you know. But I would also, I would add the quarterly meetings.
Yeah,
and that quarterly meeting is a summary of everything that's happened. It's a celebration of 3 months.
Yeah,
you know, so now every 3 months you're celebrating successes of 3 months.
Yeah,
and that's when you review. I would bring in things like, you know, the last 3 months we bought down the mortgage, $3,000.
Yeah.
In the last 3 months, the house value has gone up 3%. So it's gone up $6,000.
Yeah.
In the last 3 months, we've generated, you know, $1,500 in income.
Yeah.
So you start shining the light on a bunch of positives.
Yeah.
On a regular basis.
Right.
So what that does is what I find that does is it'll actually increase the level of trust in your joint venture partner, because we both know once trust is gone, you're screwed.
Yeah.
You are completely screwed. And we've had partners in the past where once they lose trust, now they lose trust because they make up a story in their mind.
Yeah. And that's a bad feeling on the other side, to feel like the other person is skeptical of what you're up to. It's not a good marriage. I mean, you wouldn't want to be skeptical of your husband or wife. I
was gonna make a joke, but I won't.
Probably not. Before that, okay. So the big thing is setting up the expectations in writing at the front end. You know.
Well, that's what your contract is.
Yeah.
But a lot of times, you know, we were taught back in the day 5-year terms, you know, 5-year agreements.
No, I mean further than that. We had contracts with everybody. We've always done the legal side of things properly. I mean written agreements where, you know, if I look at both of our parents, and who both have got out earlier than they should have, because of not understanding this was a long-term play. Well, and maybe for their age that wasn't the smartest, and it worked out okay for them because we did them well.
They made money in their defense. You know, they were older.
Yeah.
And they did experience, you know, 19-20% interest.
Yeah.
So when things change, when the economy starts shifting, you know, fear kicks in a lot faster to them than it did for us, because we were, you know, we're 27, 28, and we were, you know, young and eager, and, you know, to use an expression that I love using is we were hot and horny for real estate. And we were actively running off building this portfolio. So it didn't really phase us too much, and we never saw 20% interest like they did. So that's why they wanted out.
Yep. Yeah, which is fine, but I mean, having something clear to come back to.
So what kind of agreements would you have in place? So when you say agreements, you know, what I'm hearing you say is expectations.
Yeah.
Versus an agreement like a legal binding. You know, here's my lawyer did this up, so on and so on, right?
Yeah.
So what kind of agreements, expectations, intentions would you set? Once again, going back to that very first client that joint venture partner.
Yeah.
What agreements, expectations would we set?
Well, I think what I didn't understand when I got into real estate is just because you want out of real estate doesn't mean you're getting out today. And how often are we seeing that?
Totally. So
the expectation that it's long-term, but things can always change.
So what's long-term? What would long-term be to you?
Well, that's everyone has a different strategy, but for us, it's 10 plus years.
At least 10 years.
Yeah.
when we started, we were doing 5-year terms.
Right.
And I look back now, I wish I never even had the conversation of a 5-year term.
Right.
It should be a 15-year term.
Yeah.
Versus even a 10-year term. Like, I'm even hesitant to telling anybody who's watching or who is going to watch to do a 10-year term.
Yeah.
It would be a minimum 15 years.
Right.
You need enough time to buy down the debt, because I don't believe you can make a mistake in real estate. I don't think you can buy the wrong house. You just got to wait it out.
Right.
And you might have to hold that house for a little while longer to move it versus, selling it in 5 years kind of thing.
Right.
But if you don't map out that clear intention, expectation, direction with your JV,
yeah,
they're and if they think it's in 5 years, they want their money.
Well, and understanding that just because we say 5 years right now or 10 years doesn't mean in 10 years we know what the market's going to be like. Mm-hmm. So right now, for instance, there's some properties that if we could sell right now, I'd absolutely sell, just to simplify a little bit and downsize and pay off some other debts. Mm-hmm. And I'd liquidate a little bit, but it's not really an option quite yet. So if we were at the end of a term with a joint venture where this is 10 years, we said we were getting out, they would need to understand at the front end that just because we said 10 years, it may not be the smartest time to sell out.
Right. But that all has to be in your legal agreement.
Yeah.
Not your, intentions or expectations agreement. Like, that's got to be documented by your lawyer on, here's what happens if we don't get this much value in the house. We're not going to sell. We're going to hold on for another 5 years. But
like, how many people, there's a certain amount of people that are going to, if you have a relationship with someone, maybe sometimes you don't sit and look at the legal agreement as closely as you should. But were I to do again, and we're going to get professional about joint venture agreements, just like we do this actually in our property management company a lot. We have checklists to make sure that we followed, especially with our lease agreements and things like that, because there's so many pieces that can be missed. So we have a checklist of all the things that need to get covered in the lease agreement. I would have a checklist, a joint venture agreement checklist of making sure I've had the conversation of all those detail things that we just talked about, so that, it's like checked off. Yeah. December 5th,
here's 19. The date. Totally. Emails inside, conversation. I just had an idea.
I just about said 19 something. Did you catch that? We're in the 2000s.
We're not just in the 2000s. We're like 18 years into the 2000s. So
I digress a few decades.
So as you're talking, I have an idea.
Okay.
I'm going to table this idea to you, and it's totally raw. It literally just came to me.
I'm a little nervous.
Yeah, you should be. It's going to throw you into some uncomfortable patterns.
Okay. Wow.
Do you feel that there's a need to educate and teach joint venturing properly?
Oh, of course.
Do you want to put on a course to do it?
Do I?
With me?
Oh, yeah,
it's
maybe.
Needed.
Yeah. Oh, it's for sure needed.
So, you look around right now, you look at all the people doing joint venture agreements with, friends and family and coworkers, or, people. How many clients do we have are actively looking just for random people to joint venture?
Yeah.
You see posts on various websites and Facebook pages looking for joint venture partners. I don't want to say I don't want to say we're the best at it. However, we've made a lot of mistakes at it.
As with anything.
And I think we're pretty darn good at joint venture partners.
Well, we weren't.
I understand that, but right now we are.
Right. Well, because of lessons.
Because exactly. So all the lessons and mistakes.
That's why we're good at property management too.
Absolutely. So why not commit to doing a workshop out of Edmonton, because that's our home base. And or we can even do it over Skype or do some kind of webinar on joint venturing. And, my thought is, because what I keep on defaulting to is a workshop, but why not do a half day or a full day workshop on joint venturing?
Yeah. Maybe
this is a massive topic.
Well, maybe it's, we'll have more to come on that, but.
So will you percolate that idea?
Yeah. Well, what excites,
but you're a big part of that movement.
The only piece that excites me about that is the structure, administrative pieces to it. Just because I don't want to say regret, but kind of regret. There's a lot of regret of how it could have been done so much better.
Right.
So
if our commitment is to empower, educate, support other people watching the show today,
Yeah.
or previous shows or future shows, if that's our commitment, then we almost have to do the joint venturing topic.
Yeah. Yeah. Agreed.
You know, like
I know. I wish these nuggets were probably out there somewhere for us. We just didn't.
They were hard to find if they were, because the internet, we didn't have, you know, FaceTime or whatever this thing's called. What's this thing called?
Facebook Live.
Facebook Live.
Yeah.
We didn't have Facebook Live,
Right.
you know, in 2003, 4, 5, or whenever we were doing joint ventures, right?
Yeah.
So if so they might have been around, but unfortunately they were next to impossible to find. So our commitment is to, we have a saying with us and our marketing team is, we want to give the shit you can't find on Google.
Yeah.
And if we're bringing the shit you can't find on Google, this is just a step into that direction.
Right.
Okay. So let's.
When you might find pieces of it, but maybe what we could deliver is the entire package.
Absolutely. So let's give that package.
Yeah.
Let's make it raw and just real raw, just real. And, let's just give people shit they can't find on Google.
Let's help other people keep their marriages together of their joint ventures.
Yeah. JV marriages.
I see a name.
And spousal marriage.
The JV marriage course.
Absolutely.
Okay. We digress.
Okay.
What are some more challenges that we can help people?
I think a common mistake that people make, and we were one of them, is we refinance our portfolio too often.
Yes.
And and I've shared this story before on Tuesday Tilt Talk Tuesdays. Sorry, Tuesday Tilt Talk. And I share this story often from stage. And one of the regrets that I have in this business, and I don't have many because I've learned lessons from all of them, but with our JVs, I really wish I wasn't refinancing the properties. Right. At the time, it was super cool refinancing them every 5 years and pulling out your 50 grand per property. And if you have a portfolio of 10 properties, that's 500 grand. Mm-hmm. And, there's 250 to you, 250 to us. We were fortunate because we were putting our 250 back into our portfolio, buying more properties, renovating, whatever it is. Yeah. What we came to realize, or have come to realize over the llast 14, 15 years of doing this with joint ventures, is they weren't doing the same. And that's a big problem. I wonder
if you ran the numbers on that. This thought came to me. If you ran the numbers, if you'd never done it, where you'd be compared to having done it. Like, we're a little different because we put it back in, but
I can tell you where we look at our portfolio versus our joint venture portfolio. Yeah. Like we have two examples. One portfolio has 20 properties in the exact same city, and another portfolio has 40 properties or whatever it is. And you look at those two scenarios, this one portfolio of 20-ish properties, like, we keep on feeding this portfolio. Yeah. But we've never cut a check to feed the portfolio. It's always come out of our other portfolio. Yeah. Because all we've been doing over the last 15 years is buying these down. Yeah. Whereas for the last 15 years, these debts are the exact same today as they were when we bought them. Yeah. So although we've pulled the money out, that's great. Yeah. Our partners forget about that. Yeah. As much as we can count, so we don't have anything written down. We have no ledgers. We have no.
No, it's not true. That's not true.
No, we do, but we weren't reporting it to them.
Yeah, yeah.
And it's so hard to go back now and say, "Oh, remember this? Remember this? Here, we've done this. We drew this."
Well, it's all in the books, but it's not as concise as it should be.
None of that matters when you're cutting, a $15,000 check every 3 months.
No, absolutely.
So. There is a live example where we can actually sit there and say, here's our portfolio that we've been buying down. Here's this portfolio that we've been refinancing. Who's further ahead? Yeah. This one's further ahead all day long. Yeah. If I were to be sitting down with a joint venture partner today, I'd go back to them and say, listen, Krista, you want to do a joint venture? Here's what we're going to do. We're going to take your money. We're going to keep it in the bank account. We're never touching it. Yeah. After 5 years, maybe we'll cut a check. Yeah. But if we cut a check, we're going to leave half of it in the account. We're going to take the other half and we're going to put it, we're going to cut 50-50 maybe. Yeah. The other thing, Krista, we are never going to do is refinance these properties. Yeah. So you might not like that. After 5 years, we might have to do a little bit of a cash call sometime in the next 10 years. But after 10 years, we're going to be riding into the sunset. Yeah. Because you would have bought the debts down far enough that even if rents drop, you're still fine. Yeah. So, those are some of the mistakes that I like. Looking back now, I really wish we never refinanced one of our properties. In saying that, though, sorry to interrupt, in 2008, 9, 10, I'm glad that we did refinance them, because that is actually what got us through that downturn. Yeah. Or got us further down. Otherwise, we would have been bankrupt. Yeah. So there was a place for it, Since 2010, we haven't touched one of our properties,
Right.
but we continue to refinance the portfolio of the other guy.
Yeah.
Which is causing some problems.
Yeah. What keeps coming to mind is ego is the enemy. And there's that book that you read. We could say ego is the enemy in real estate.
Ego is the enemy for everything.
Anywhere. Yeah.
Right.
Agreed. So we've covered off everything in writing.
Yeah.
Just to recap.
Better reporting.
Yeah.
Don't refinance.
Yeah.
Save all cash.
Yeah.
And then the other thing I would add to that is if you were the managing partner, pay yourself. So create a joint venture, a property management fee of, if the norm is 10%, maybe you charge 8% because there has to be something for managing the portfolio.
Right.
The mistake we made back in the day was we were buying properties and we weren't charging the management fee to the partnership. We were managing it for our split, our 50-50.
Yeah.
And which worked out great when there was money to be made.
It's again like the marriage.
Totally.
How many people get into a marriage with clear expectations of who's doing what, right? And so that's so funny how much it parallels a marriage. And it's not fair for one person to be doing more, carrying the weight of the other.
Well, totally. So that was, we didn't have this agreement. So when things got tough and we left our job in 2008, the jobs, you sold your company and I shut down my training stuff and we went full-time management or full-time investors. We didn't have the math or the portfolio to support our life. So we started charging management fees and all of a sudden there was an imbalance because before that, there was an imbalance because, our partner, we had a 50-50 partner who put in 50% of the money. We put in 50, and that's another thing I would never do is putting in half the money.
Yeah.
I would never put in half the money again. And it's a joint venture is putting all of the money or none of the money. And if they're putting none of the money, then I'm putting the money and that means they're doing all the work.
Right.
If they're putting all the money, that's the trade-off. When it's a 50-50, it is so tough to manage because now you start getting unbalanced.
Yeah.
And it's like, oh, I'm doing more than he is. And, that's not fair. This isn't fair. And all of a sudden you start shining a light on all these problems and the marriage starts falling apart.
Yeah.
So that's another correction I would never do a 50-50 split of money.
Right.
I just see a lot of potential problems with that.
Yeah. Yeah.
David Nielsen put, looking forward to the JV marriage course.
It's happening. With all the work we've done in our marriage, awesome. It's just natural to put on a marriage course.
I love it. No, listen. Okay, so you've had a few minutes to think about the JV marriage course.
This is so how Jared operates.
Are we doing it?
I've had time to think about it.
No, so we sit down with we're in the process of doing estate planning right now with our guys, and so we sat down with our estate planner today, and he comes up with this new idea. And you know how I am. And he comes up with this idea. I'm like, yeah, okay, let's just do it. Yeah. Done. Let's just do it and let's go. And so with that concept of my mindset explained and described, you've had a few minutes to think about the JV marriage course. Like, what are your thoughts? Krista, we can impact so many people with a JV marriage course. Yeah. And I like the name.
Yeah.
And, our social media presence is getting huge and our marketing is fantastic. And so let's start marketing it. Let's put it on. Let's do it out of Edmonton and let's bring people in.
This is very strategic of you to ask me on Facebook
I know.
Live. It's perfect.
Now you have to say yes.
Yeah, no, I mean, it sounds fun. Yeah, honestly.
But let's do it. Because if our mandate is really to, to change the system and change the game. Well,
if we could help other people avoid the messy marriages we've had, who wants a messy marriage? Who wants hard feelings? Let's just all be friends and let's be clear on our agreements and yeah.
Okay, so let's go back and forth, rapid fire.
Oh, I don't do rapid fire very well.
Yeah, let's go rapid fire. Let's go let's just rattle off mistakes that we've made in joint venturing that we would do differently.
Right. We've covered a lot.
Yeah, let's just rattle them off. Let's try to get to
go. I don't do rapid fire.
Drawing cash flow out monthly.
You already said that.
No, it doesn't matter. We're just rapid firing.
Not writing down every conversation.
Okay, so everyone who's watching, if you're just tuning in or if you're about to tune in, This is essentially the summary of all the mistakes we've made in joint venturing.
Yeah.
So this list that we're about to create is your marching orders on things not to do,
Right.
essentially.
Right.
Okay. So what was your last thing?
It was
Not reporting properly.
Yep. No, but not writing down the communications.
Oh, right. So not reporting the communications or tracking the communications.
Yes.
Refinancing the properties every 5 years.
Right. Not creating agreements in the beginning of what the long-term plan was for it.
Agreements as in intentions.
Yes, intentions and talking about what happens if this, what happens if that.
So not properly outlining scenarios.
Yes. Thanks. Good, concise.
Yeah.
Yeah.
And I love correcting you. It makes me feel so good.
I love it.
Buying poorly cash flowing properties.
Yeah. Oh my God. See, again, ego and greed.
Yeah. Which wasn't protecting my client's asset.
Right.
Most people think that we've been taught that the house is the asset. When I teach and I tell people, I explain to people that the asset's actually the cash.
Yeah.
Not the house. The house is the vehicle that makes you money.
And not making sure the partner clearly understands the roles of the people in the partnership. And so, especially if you're the one doing the work, the partner needs to clearly understand what work you're doing.
Mm-hmm.
And so if the agreement isn't to get paid for that, but understanding the worth of it, I guess,
right.
Because maybe that can't always be that worked for us, for instance. Well, we had other jobs to support ourselves, but
Mm-hmm.
when we had no choice but to take over our portfolio because it was too big for a property management company to manage, mm-hmm. we had to be paid somehow. So, yeah.
Totally agree. Having a 5-year term.
Not having a 5-year term.
No, that's the mistake, is having a 5-year term.
Oh, I see.
So to me, it should have been a 10, 15-year term. And I'm, like I said earlier, I'm even hesitant saying a 10-year term. I would say a 15-year term minimum. Right. And then in the 15-year term, I would say I would open it up at year number 8 to reevaluate that property or the portfolio to determine if you can sell it. But it doesn't trigger a sale. It just opens it up to a reevaluation for a conversation to determine what the next steps of the property is. Right. Because then, if you can't agree, then it automatically defaults to 15 years.
Yeah. Would you self-manage again if you?
No, we're going tit for tat. Let's go. I'm going to ask you your question. We still have that question.
I want to say this because there's going to be people this applies to. It didn't apply to us. I wouldn't self-manage. And my state, we had to because we tried really hard. We tried to get a company to start so that they could take us on in Grand Prairie. Yeah. Because we'd implode a regular property management company with the volume of properties that we had. Anyways, so we had to self-manage, but.
So you wouldn't self-manage?
Not for a joint venture.
Okay.
Because it's messy.
Right.
In that there's just this, they don't understand.
Well, they don't understand the value of it, part of it. And it all depends on how you set that up. Because if you set it up properly at the start, we did not set it up properly at the start. So all of a sudden when we started charging for property management, they're like, well, that was part of the deal.
Yeah.
So.
And when then trust gets eroded, and then when you're the property manager or you're self-managing, that's pretty tough to be managing for someone who doesn't trust you. Look at our clients. If we have a property management client who doesn't trust us, because of whatever, it's really difficult to do a good job managing for them because then they're questioning everything you do.
Yeah, totally. Another mistake that I would do differently is I would have quarterly or semi-annual visits to the houses. Mm-hmm. We have joint venture partners that never have seen the properties.
Right.
And how can they make it real if they've never seen it?
That's a really good point.
I just thought of it.
Yeah.
And literally, as you're talking, I'm like, oh my God, I wish we did this.
Yeah, it's not physical to them.
Absolutely, it's not real.
I don't know if any of them have seen.
Not one.
Any of them.
Not one.
Interesting.
Not one.
Yeah, and I can get that because truthfully, I get a little out of touch with our own portfolio in Grand Prairie at times because I've spent less time in the properties than you. Mm-hmm. And so, but when I've gone and gotten in touch with them, it's like, there's a different energy in it.
Totally. But now you can see the vision, you can see the future, you can feel it, you can see, so now all those problems that are coming up, they become less of an issue because here's the actual tangible property and here's the vehicle that's making you money.
Which is funny because I'm going to just go off on a little tangent here for a second. This is why we love real estate. And how do they get to love real estate like that? We love real estate because it's a tangible asset. Bottom line, wouldn't you say?
Yep. Once again, I don't think the real estate is the true asset. It's the house. That's the money. That's the asset.
Yeah.
That's what I'm trying to protect. The house is the vehicle for my success.
Sure. Get into that. That's semantics in a way. It's the difference between a stock and a. Yeah. Sorry, I'm digressing here a little bit. But
you are going on a tangent, so go ahead.
I am.
A tangent, you can go anywhere you
want.
I
get to once in a while.
No, do it. You sure talk a lot today.
No, anyways, that's interesting because I think that's something that's forgotten in real estate is the tangibleness of owning a property.
If I were doing it all over again, I would seriously every 6 months buy a plane ticket and bring in my joint venture partner, or hop in the car and drive to the city, or hop in the car and grab a coffee and go do the inspections. And you don't have to necessarily go in the house, but show them the houses and make it real and make it exciting. Celebrate the success, celebrate the journey. Looking back now, I look at all the problems because I just came up with this idea just now. But looking back at all the challenges that we've had with JVs and communicating with them, I think a lot of them could have been squashed.
Yeah.
If they were actually bought into the dream completely in the vision like we were.
I felt it.
Totally. Because we were living it every single day.
Yeah.
Whereas they weren't, right?
It's very true.
What else?
Well, we're getting up to 46 minutes here.
I don't care. Let's keep on talking. Anything else then before we go?
Well, no,
I'll answer your question.
I want to come back to your question. The question. Do you have anything else before you answer the question?
Well, there's lots, but we're going to do the JV marriage course. So we got to save some stuff for people to come back.
Not necessarily saving, but I think we've highlighted a lot of things. Really, today was about talking points, things to think about, things to look at, and just, to go in with your eyes wide open. And okay, answer. Let's hear it.
Would I do it again? Would I go as big? I don't know. I think looking back now on what I know, I would, but I would never go to 20 or 25 properties with a JV. I think I'd stop at like maybe 2 to 4 properties at the most with a JV. It's easy to report. They're not at risk for as much if you go too big. Like we have JVs that have given us $800,000-$900,000, and we've gone off and bought 10, 12, 14, properties, right? I think that's a little too big.
Yeah.
I think I'd stop at 2 to 4, 2 to 3. Easy to report, easy to manage. If the market changes, they can probably swallow it a little bit.
Yeah.
And absorb some of it. But yeah, I would do it again, knowing what I know now and knowing all those mistakes that we've made, the corrections.
Yeah.
Lots of things I wouldn't refinance. I would take out cash flow. I'd have longer terms. I'd have better communication, lay out the intentions and expectations along the way. But yeah, I would do it again.
I would actually keep it. I feel like the less partners you have, the easier to manage.
Absolutely.
And that you have multiple partners with smaller portfolios. It's a little bit more laborious.
Well, I'm not saying I would have multiple partners.
Okay.
I'm just saying if I was to take on a joint venture partner, I would have 2 to 4
and stay smaller.
And I wouldn't go to 100 doors or 100 properties. I would, go to 20 and go get 3 on your own. 4 on your own, go get a joint venture partner for 3, joint venture partner for 3, joint venture partner for 3, and I'm good.
Yeah.
And pigs get fat, hogs get slaughtered, so just always be a pig. It's true.
I like it. I'm just going to throw one thing out there. I didn't even tell you I was going to do this, but it's funny, in our financial planning meeting that we had earlier today, we had a really great conference call. We conferenced our accountant in.
Yeah.
And we've talked about this before, but if you're listening for the first time, or, I'm going to throw this in there as often as possible. This is my baby end of the business, which is admin and accounting. Get a good accountant and pay them well, grow with them. And it's, overpay at the beginning when you can't afford it. And how many years have we been investing now?
Since 15 years, 16 years.
Yeah. So that's how long we've been with our accountant. And it drove us crazy at the beginning of how expensive he was for what we were up to. Mm-hmm. But we'd read that. I think.
Well, the call today made Wayne and what we paid him over the years like worth every penny.
Yeah,
It
it's
was
funny
awesome.
because we've had lots of different meetings with financial planners, and there's a lot of, just they're pretty snarky with accountants, and they
Yeah.
don't trust. So what it tells me is there's obviously a lot of horror stories with accountants,
Right.
and you thinking you're in good hands and things are being done right, and they're not. So I just want to reiterate: get a good accountant, have a good set of books,
Mhm.
take care of your accounting, and create a great relationship.
Yeah, take care of your accounting.
Yeah.
in your system, and you'll have tons of success.
Yeah, especially, I mean, these taxes. Well, that'll be another thing. The new government's what they've released,
which
but
is what
the
we're going to be
truth-
talking about on March 13th in Edmonton.
Yeah, but the truth is, I'm not terribly concerned about it in that I know we're in good hands.
Yeah.
And so I don't really need to go out and investigate it too much for myself because
Right. Yeah, Wayne's going to take care of it.
We have really great advisors.
And we're bringing Wayne out on on Tuesday night, March 13th in Edmonton for, we're going to be breaking down the federal budget, talk about the impact to investors. We're going to have open question, open mic kind of stuff. Yeah, and that's the whole point of our groups. Our groups are meant to stay small. We have under 100 people. We don't want to cap out. We don't want to go over 100, but the rooms are small where we want to be able to answer any questions. And bringing Wayne in, we went and created a group of premium service providers is what we're calling them, where these are our people.
Mm-hmm.
These are our people that we've used for years, and we're going to give them, let them loose to the public, to our group. I know it's scary.
Treat them well.
But if our commitment is to give and to serve and to help people out, that's just what you do.
Yeah.
And
because if I were greedy, I wouldn't share them.
And nor would we do our JV marriage course.
I know, that's true.
So
yeah.
let's
but we want everyone to have great marriages.
Absolutely.
Yeah.
And JVs.
Like we do.
Yeah. Okay, everybody. That's Jared and Krista with Tuesday Tilt Talks. Thanks for tuning in. If you have any questions going forward, just by all means, blast us an email, put a comment, put a post, share it, like it, follow us on Facebook, also on Twitter. Krista has a monthly or a weekly radio show as well. That make sure you tune into that. What's the website for that? Do you know?
I don't know.
What's the number they can call? And you should have that.
I have no idea.
Okay,
it's making sense of mindfulness. So it's to de-stress from the world of real estate.
Making sense of mindfulness. Follow Krista on Facebook. She'll put a link every Monday at 5:30. 5:30?
Yep. Pacific.
Yeah, 5:30 Pacific time. It airs, so make sure you follow it. And it's pretty cool. Her and
I'm co-hosting with Keith McPherson.
She co-hosts with Keith out from Winnipeg. So everybody, thank you for tuning in. We'll be back next week at the same time, same place, roughly the same time. We're going to get that dialed in at some point. 1:30-ish PST time. We'll be back next Tuesday.
Yeah.
That's it.
Have a great week.
Thanks, everyone.
Send any questions.